Welcome back to the channel, investors. Today, we're diving deep into a stock that's been flagged by our screeners for extremely high cost to borrow fees, a key indicator for potential short squeeze setups. We're talking about Decent Holding Inc., ticker DXST. Get ready to understand exactly what makes a stock hard to borrow and why it could ignite explosive price action. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show DXST logo/chart. Let's zoom in on DXST, or Decent Holding Inc. This company operates in the industrial sector, specifically within waste management, providing industrial wastewater treatment services in the People's Republic of China. They also offer ecological river restoration and river ecosystem management services, along with microbial products. DXST is a microcap stock with a market capitalization of just $5.07 million. Its estimated float, the number of shares readily available for trading, stands at a very small 1.2 million shares. Now, looking at recent price action for DXST show price chart today, it's done 4.43%. However, over the last 5 days, DXST has seen a gain of 15.11%, and looking back 30 days, it's up an impressive 31.47%. This shows some underlying bullish momentum despite today's dip. Volume-wise, today we're seeing 218,098 shares traded, which is significantly lower than its 30-day average volume of 1,563,053 shares, giving us a relative volume of only 0.1x average. Where's cost to borrow and why it matters? So, what exactly is cost to borrow, often abbreviated as CTB, and why is it so critical for stocks like DXST? When investors want to short sell a stock, they first have to borrow shares from a broker. They then sell those borrowed shares hoping the price will drop so they can buy them back at a low price, return them to the lender, and pocket the difference. But borrowing shares isn't free. Brokers charge a fee for this service, and that's the cost to borrow. It's usually expressed as an annualized percentage. This fee matters immensely to short sellers because it's a constant, ongoing expense that eats into their potential profits, or worse, can turn a profitable short position into a losing one, especially if the stock price moves against them. A common question is, how can a fee be over 100%? Well, if the demand to borrow is incredibly high and the supply is extremely low, brokers can charge exorbitant daily or weekly fees that, when annualized, can easily soar past 100%, 200%, or even, as we'll see with DXST, much higher. Why this stock is hard to borrow right now? Show CTB stats. This brings us to why DXST appeared on our hard to borrow screener. The annualized cost to borrow fee for DXST is a staggering 666.5%. Let me repeat that, 666.5%. This is an incredibly high fee, indicating immense demand to short DXST shares and a severe scarcity of shares available to borrow. While we don't have real-time data on the exact number of shares currently available to borrow, a fee this high strongly suggests there's practically nothing left or that it's being rationed. Combine this with DXST's small estimated float of just 1.2 million shares, and you have a recipe for extreme borrow scarcity. A high CTB like this acts as a ticking clock for short sellers, increasing the pressure on them to cover their positions, especially if the stock starts moving up. However, it's crucial to understand that a high cost to borrow does not guarantee a short squeeze. It can also signify that short sellers have very strong conviction that the company's prospects are poor, and they are willing to pay a premium to maintain their short positions. Our internal composite squeeze score for DXST currently sits at 45.8 out of 100, indicating some factors are in place, but it's not signaling an imminent guaranteed squeeze. Squeeze mechanics explained. So, what happens if a stock like DXST, with its extremely high CTB and small float, does enter a short squeeze? A short squeeze occurs when a stock's price rises sharply, forcing short sellers to buy back shares to limit their losses. This buying activity, in turn, pushes the price even higher, creating a snowball effect. Here's how it typically unfolds. 1. Short sellers bet against a stock like DXST. 2. Positive news, increasing investor interest, or simply increased buying pressure starts to push DXST's price up. 3. The extremely high 666.5% cost to borrow starts to really hurt the short sellers' profitability, turning their positions deeply negative very quickly. 4. Faced with mounting losses and crippling fees, short sellers panic and begin to buy back shares to cover their short positions. 5. This forced buying creates even more upward price momentum. 6. Because DXST has a small float of only 1.2 million shares, even a moderate amount of covering can quickly exhaust the available supply, sending the price soaring. It's a classic supply and demand imbalance driven by forced buying. Dilution risk check. When we talk about potential short squeezes, we always have to consider dilution risk. Dilution occurs when a company issues new shares, which increases the total number of outstanding shares. This can effectively dilute the value of existing shares and provide new shares that short sellers could use to cover their positions, thereby negating or offsetting any squeeze potential, even when the cost to borrow is high. For DXST, our check reveals no recent diluted SEC filings such as -1s, -3s, or 424 BS found in the last 90 days. We also found no recent reverse split for DXST in our look-back window. This lack of recent dilution is a positive factor for any potential short squeeze thesis, as it means the company hasn't recently created new supply that could satisfy short covering demand or soak up buying pressure. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For DXST, there are several key indicators to keep an eye on if you're watching this hard-to-borrow situation. First, monitor the cost to borrow. Is it sustained at these extreme levels, or is it even increasing? Second, watch for significant increases in volume. Today's volume for DXST is quite low at 218,098 shares compared to its average. A true squeeze typically requires a dramatic surge in buying volume. Third, observe the price action. While DXST has shown positive momentum over the past 5 and 30 days, today's dip suggests volatility. A sustained upward trend, especially on increasing volume, would be a strong indicator. Finally, keep an eye out for any company-specific news regarding Decent Holding Inc. that could serve as a catalyst for either upward or downward movement. Remember, with a small float like DXST's 1.2 million shares, price can be highly volatile on relatively low volume. So, there you have it, a deep dive into Decent Holding Inc., DXST, a stock currently exhibiting an astronomical 666.5% cost to borrow fee and a very small float of 1.2 million shares. It serves as a fantastic real-world example of the mechanics behind a hard-to-borrow stock and the potential for a short squeeze. While DXST ticks many boxes for a hard-to-borrow candidate, remember that high fees alone do not guarantee a squeeze. Always conduct your own thorough due diligence. If you found this breakdown helpful, smash that like button, subscribe for more in-depth stock analysis, and let us know in the comments what stocks you want us to cover next. Until then, happy researching, and we'll see you in the next video.